Hello, everyone. Welcome back to the Virtual Investor. So, in the last episode, we went over some of the headwinds or some of the tailwinds, I should say, in the market. Tailwinds that are pushing the real estate market up and why they're pushing the real estate market up. Today, we're going to go over some of the headwinds, which are the things that are pushing against us and are things that could potentially knock the real estate market down, knock the global economy down, which would then in turn push the real estate market down. And what are these different things that can happen that can really knock the market and send it in the wrong direction? All right, let's dive into it right now. So the first thing, and I'm going to show you guys, do a little screen share here for you. All right, so the first thing we got here is layoffs, right? So the number one thing that can happen to really put a halt to the real estate market is a massive increase in job layoffs. And we're starting to see here when Walmart cuts workers, because Walmart's big retail, right? When they cut workers, we've already seen Amazon cutting workers. This is the first telltale sign. This is a leading indicator as to what is going on in the market and what we're facing. So more than 2,000 jobs were cut by Walmart, and Walmart's not alone. Now you've got McDonald's cutting jobs as well, but maybe McDonald's is cutting jobs because there's maybe more robotics involved and less people are needed to cook and to serve people, which is a possibility there. But I have a feeling it's more to do with their cost. I happened to go to McDonald's the other day and I got a large fry and it was $3.50. The price has gone through the roof for French fries and basic stuff at McDonald's. So what was inexpensive fast food is not inexpensive anymore. And they're being probably hurt big time by competition like Chick-fil-A, maybe Wendy's and Taco Bell and others. But we're going to start seeing more and more layoffs here. You've already been seeing over the past year tech jobs being hammered. And we saw the tech jobs really influence the cost of real estate in areas like Seattle, San Francisco, Phoenix, Arizona, Denver, Colorado, and other markets as well. So if we continue to see this with retail, we're going to see things, markets affected all over the place. See, Roku is cutting 6% of its sales force. Disney's actually cutting 3.2% of its global employees. That's 220,000, a lot. Bed Bath and Beyond is getting rid of a lot of people. So you have a lot of layoffs here. And looks like Amazon is cutting more. 9,000 employees are going to be cut. That's pretty substantial amount, right? Especially considering how much Amazon has grown over this since the pandemic and even beyond before that. A lot of layoffs coming. This is the number one headwind we've got to worry about. And I'd say the number two headwind would be the banking crisis, which we're in the middle of right now. We're already seeing it. We saw it with Signature Bank, with Silicon Valley Bank, and Credit Suisse overseas. And this is just the tip of the iceberg. There is a lot more to come. There's a lot more carnage to come in the banking industry. It's going to get ugly, and it's going to benefit the cryptocurrency. So look at Bitcoin. As you've seen, it's now over 30,000. It was 16,000, I believe, in December, and now it's at 30,000. It's almost double in a short period of time. A lot to do with the poor information coming out in the economy, and jobs, obviously, but also the bank crisis is what's really pushing it down. And it's going to continue to push gold, silver, and cryptos up. More cryptos. But gold and silver will have their benefit. They've already had a nice little spike and they'll have a downturn, but they'll come back up again as well. And the next thing that can affect real estate in a negative way is what you're seeing going on recently with China and potential escalation of war with Russia and China. There's been a lot of hostility going on here, and you can kind of see the handwritings on the wall, the direction we're going here. It looks like we may have some kind of something. Well, you hope it's not war, but there could be something going on. There's already some military stuff going on between us and China, and you just hope it doesn't escalate. But you kind of have the feeling that it is going to, and that could negatively affect the real estate market because it could really rattle the stock market, rattle the bond market, and of course the bond the 10-year T-bond is what mortgage rates are based off of. So if that gets affected in a negative way, you could see rates increase. We'll see how that goes. It's more likely to go the opposite direction where rates would decrease, but there's still the possibility that that happens. The other thing that could continue to affect unemployment in a negative way is the advancement of AI, artificial intelligence. And since we've seen ChatGPT come out there, November last year, we've seen some of the things it can do and how it can create articles very simply. So does it develop? And they're talking about the end of this year, how much this is developing. Could it replace journalists? Could it replace writers? Could it replace book writers? It could take so many jobs away in different fields that, again, you're going to affect the economy in a negative way. So this is something to totally look at here. That could be a negative factor. Now, the most important one is one we already just touched on here, mortgage rates. If mortgage rates go the wrong way, then we are in trouble. Right now, we have mortgage rates going the correct way, downward for our market. This is exactly what we do want, them going down, heading into our spring market. But there is a chance that we have some escalation of war or we have other issues that could cause problems and push rates up. So this is something we really got to keep our eyes on. And something I'm keeping my eye on, and we'll see where it goes here. Inflation is a big factor too, right? Because what happens is more things cost, more food costs, more fuel costs, the less spending you have, the worse your debt to income ratio is, the less people that can qualify for a mortgage. So if everything costs a heck of a lot more, then you have less disposable income. If you have enough income showing in the bank there, you can't close on your mortgage. You're not going to qualify for a mortgage. You're not going to be able to buy. So there's less buyers in there. Great for the rental market because there's more renters then, but not good for the real estate market if you have less buyers. What you need is what we have now, more buyers than supply of inventory, which is what causes the prices to stabilize or even potentially increase, like CoreLogic is talking about. And this one's about headwinds. So it's about what can cause it to go down. This is what can cause it to go down. Unemployment, one, mortgage rates increasing, bad things going on in the economy and potentially throughout the world with war. These are the big headwinds that we are facing. AI could be a headwind. We just don't know. We don't know where that's going with it. I have a feeling it is. But then, the government might offset that with universal basic income for those people losing their jobs where they're getting subsidized by the government, which would then maybe potentially allow them to qualify for a mortgage that they couldn't qualify for before. So we will see where this goes, but those are the headwinds. That's what it looks like we're facing. Hopefully things turn out for the better. Hopefully we got more tailwinds than headwinds, so we continue in a positive direction. All right, guys, we'll catch you on the next video. Good luck in investing.